All right, so in chapter 20 today, what we're going to be looking at is master budgets and what we call performance planning. So this is more of what we are going to be looking at, say maybe at the beginning of the period. And then at chapter 21, we'll look at variance analysis, which is what we'll deal with typically at the end of the period to see, did we meet our budgets? Where did we go awry? What can we do to improve in the future? All of those types of things are questions that will be answered in chapter 21. But here in chapter 20, we're going to work on establishing baseline budgets for all of the different areas of my organization. So what we will see in this chapter to go ahead and start off with is just a brief discussion on essentially why we budget. So what are the benefits of budgeting? So we'll just run through these pretty quickly. We'll start at the top and we'll just work around clockwise. So we'll see coordination is our first one. And we're trying to identify ways that we can get our activities to actually contribute to the overall goals of the organization. So I'm trying to find ways to eliminate any duplicate procedures and coordinate all of my activities effectively. Now, the next thing that we see then is communication. So we're trying to have management actually communicate with employees. This will lead to what we call a bottom-up budget or a participatory budget, which is typically a better type of budget because it does involve input from those who are being put under this budget, which is a good thing. Whenever the next one that we see, we look at coordinate once again. This, of course, will help employees and departments work toward meeting the company's overall goals. Now, the next benefit is kind of a double-edged sword, and it is motivation. So we have to be careful if we want to motivate with a budget, because if I actually set up a budget that can be met and it is too easy, then my employees aren't motivated because they know that they can meet this budget by working half as hard as they should. Now, if I set a budget that is too strict and too difficult to meet, then I'll demotivate my employees because they'll think that there's no way they can meet that budget anyway. So what's the point in putting forth all this effort? So we have to be very careful if we're aiming to motivate with a budget, because we have to hit a budget right on that line where it is difficult but possible to achieve. And when we hit that line, this will motivate our employees to actually meet that expectation. Next, we see that this helps us plan for future opportunities and start to maybe set aside money or start to actually see areas of my organization that need improvement. And that's what these budgets are going to help with. And of course, it will provide some type of benchmark to help me evaluate performance at the end of the period. Now, for my next piece here, we're looking at how human behavior can be affected by budgets. So in this case, we see that budgets can be positive or negative. So we have to be very careful whenever we are dealing with budgets. So one area that this can actually be positive is when we consult our employees who are going to be working under this budget. So this is what is called a participatory budget, and this is what I strongly recommend when at all possible. Now, there are times when you have to just institute a top-down budget. Maybe there's a really strict time crunch, there's just not time to do this participatory system, or maybe you're dealing with employees who have never done this type of work before. They have no idea how long this is going to take them, so you getting input from them really isn't going to be helpful. Instead, you have to determine that, all right, this should take you about 3 hours to do, and then we'll check back and see how you're doing, right? Or if you get stuck, come talk to me in the meantime. But there are times when a participatory budget just isn't feasible, but when at all possible, right, whenever you're working with a group of employees who have enough experience that they can identify how long this should take and be able to meet that target, then you should be talking to them. Because maybe you don't realize that another department just fired or had to lay off a bunch of people or had a bunch of people quit. And so now they're picking up a bunch of work from over here that they're not normally having to deal with. And so if you just start assigning them extra work and leaving that at the same normal budget, well, now you just really overloaded that department, and this can lead to some bad outcomes. So we want to make sure that we are consulting when at all possible with the people who are being impacted by the budget that's being implemented. Now, the next thing is, of course, we want goals to be challenging, but we want them to be attainable. So I don't want to set some ridiculous standard that nobody can ever meet, because that's very demoralizing. Instead, I want this to be something that you look at it and you go, man, that's pretty difficult, but if I really work at it, I think I can get there. And it'll give you that sense of achievement when you actually get that accomplished. This is a very good outcome from budgeting. And of course, this allows us to do evaluations, which will offer opportunities to explain differences between what has actually happened and what we expected to happen within my budget. So it is important that we have these evaluations happen routinely and typically as soon as possible. So if I have you work on a really large project for me, I probably should actually bring you in for an evaluation right after that finishes. I don't want to wait and just meet with you at the annual evaluation, because at the end of the year, you may have done 20 other things for the company. You may not really remember the details of that operation or what went well, what didn't go well. But if I bring you in, say you finish that project on Friday, I bring you in Monday morning and we sit down and talk about it, you can tell me in just a few minutes, maybe it only takes 5 or 10 minutes. Hey, here's what went really well. Here's where we could have improved, all these different things. And we can figure out ways to improve, and we can implement that starting Tuesday or starting Monday, right? Right away, that improvement or that different setup can actually go into effect and actually start providing benefits. Whereas if I had waited till the end of the year, I wouldn't have gotten as good a feedback likely. And that's an entire period of time where these possible benefits are being wasted or are going unused. So very good. Now, there are some negative outcomes, and we kind of hit on these. We'll go ahead and kind of look at this again. So having a budget can lead us to actually understate sales or overstate expenses. This can allow what is called budgetary cushion, where we did really well this year, so I understate sales a little bit to give me those sales in the next period, which would make me have to do less work then, and maybe it gives me this better review on a consistent basis. So it can lead to some more shady behavior. That can lean into fraudulent behavior at a certain point. This can also lead to unethical behavior and, of course, fraud. If I tell you, you got this budget, it's incredibly unrealistic, but I expect you to meet it or you're gone, well, you're going to find a way to meet it, and you may be meeting it with unethical means. And, of course, the next item is a huge problem, particularly with governmental agencies, with governmental spending a lot of times. The government will set a rule that if you don't spend the money this year, we'll give you less money next year. So if you don't have any budgetary needs this year for that extra $100,000, what's happening here is we're encouraging you to go ahead and spend that $100,000 instead of putting it back and saving it for the next period, or just returning and getting a new lump in the next year. But the problem is, if I don't spend that money now, I very well may have something that I need it for next period. But if I don't spend it, I lose it. So we spend all of the money at the end of the period on things that we probably could have done without. So we can get these issues where we're trying to encourage people to actually do good things, but because of the way the policies are implemented, it can lead to some interesting issues. So very good. Now, here we see how our budget reports typically get done. We will typically look at a budget every quarter, and then we'll have an annual budget as well. You may even drill this down into a monthly budget. That's fine. Here we're primarily concerned with the years and quarters, though. Now, a rolling budget is what is typically recommended, which is that as one quarter rolls off, you roll on the next quarter. So you start at the beginning of the year with a 4-quarter budget. So January to March, April to June, July through September, and then October to December. So you got your 4-quarter budgets. And then as soon as that first quarter ends for January to March, you immediately begin, or maybe even before that quarter ends, you start working on that next first quarter, January to March budget. That way you consistently have a 12-month rolling budget available. So this is called continuous budgeting or rolling budgeting. And it's very good as it allows me to consistently see what we're looking at a year down the line, which helps me to better plan. Now, in this chapter, the main thing that we're going to be looking at is what is called the master budget. Now, the master budget has essentially 9 components. We will be going through each of them in this chapter. We will see how to prepare the sales budget, the production budget, the direct materials, direct labor, and factory overhead budgets. And then we will look at the capital expenditures, cash, selling, general and admin expense budget. And of course, at the very end of all of this, we will deal with my budgeted financial statements. So we've got quite a lot of work that we're going to be looking at in this chapter, and this is roughly the order that we'll be seeing. So at the very beginning of all of this, I have to do my sales budget. After that, we'll typically do my production budget, and then we'll do those 3 budgets in the middle. Then after all of that is done, we can do the cash budget, and then we'll typically round out with our last two, the capital expenditures, selling, general, and admin expense budgets, and then of course, finishing all of this with those budgeted financial statements. So very good. Now let's see how this works. In this case, the very first budget I need to prepare is my sales budget. Thankfully, it is a pretty easy budget for me to prepare. So the way this works is we need to figure out how many units I expect to sell, and then how much I expect to sell each unit for. If I can do that, then I can come up with a pretty good sales budget. So it's my estimated unit sales times my estimated unit price. Now, this will start to get a little bit more involved in real life, because we'll have to actually look at the current market. We'll look at economic conditions. We'll look at if we are planning on increasing or decreasing advertising, if I have more capacity or less capacity, all of these things. Okay, so the next budget that we're going to look at then is going to eventually be that production budget. But before we get there, let's go ahead and look at an example here of my sales budget. So in this case, we see that in September 2019, Toronto Sticks Company sold 700 hockey sticks at $60 each, and they prepared the following sales budget for the next 3 months. So we expect October, November, and December to see the following numbers of sales, and we expect in each case to sell at $60 per unit. Now, this allows me to figure out my total estimated sales for each month, but more importantly for that quarter on the whole, which here is $192,000. Now, after we've done my sales budget, I can now do my production budget. So with the production budget, right, it is important that this happens after the sales budget, because I need to schedule production to meet sales. Right, I may build in a little bit extra in practice, but in here we're going to assume that production needs to match up with my sales. So a manufacturer prepares the production budget, which shows the number of units to be produced. The production budget is based on the unit sales projected in the sales budget, along with current inventory considerations. So my number of units that I need to produce, we have a nice formula for this. This is budgeted ending inventory units plus my budgeted sales units minus my beginning finished goods inventory in units. So there is one quick note we need to make, and it's down here at the bottom in bold. A production budget will not show cost. It does not. The production budget is always expressed in units. This is a very important consideration, a very important factor of my production budget. So if I ever give you a question asking you which budget is always done in units, you'll be looking for the production budget. Very good. Now, when I actually look at my production budget, you'll notice that it is immediately considerably more involved than my sales budget. And that is because I'm having to look at both beginning and ending inventory considerations. So here's where we're going to really lean on that understanding that we've already developed from earlier in the semester, that ending in one period becomes beginning in the next. If we understand that, this really isn't too bad. It looks pretty complicated, but it's quite straightforward. So let's go ahead and see how this works. So we'll just look at October and November, and of course, December will be done the same way. So for the month of October, we go back to my sales budget, and I see that I had estimated 800 sales for the month of November. So that is that next month's budgeted sales. Okay. So I come in, I am told that I need 90% of my future sales in inventory at the end of each month. So I take 800 times 90%, and that is the 720. That is my budgeted ending inventory. Now, for the month of October, we had budgeted sales of 1,000 units. So that tells me that I need 1,720 units available. Then I will need to deduct my beginning inventory, which was 1,010 units, coming down to 710 units actually needing to be produced. Now, what you will notice, I'm just going to grab my little pen here so we can use our boxes, and you will see that my budgeted ending inventory in the month of October becomes my beginning inventory in the month of November. And of course, that makes sense to us because we know that whatever I end October with at 11:59:59 on October 31st is what I will start at 12 o'clock and 0 seconds on November the 1st. So that makes sense to me that my ending in October would be the same as my beginning in November. So in this case, we'll pull in my next month's sales, which was the 1,400 for December times the 90%, tells me I need 1,260 units at the end of the month. Now, of course, that will eventually flow down to be my beginning inventory for the month of December. Now, in the month of November, we actually projected sales of 800 units, telling me I need a total of 2,060 units. If I started the month with 720, then I actually need to produce 1,340 units. So very good. Now, moving into my next piece here, we will see that my next budget is my direct materials budget. My direct materials budget will show the budgeted cost for the direct materials that are needing to be purchased to satisfy the estimated production. So this comes after that production budget, and it is the first of our 3 budgets in this region. So we'll look at our direct materials budget, and you'll notice that we are pulling straight from those calculations on our previous slide. So these 3 bottom numbers, so if we go ahead and grab our box one more time, these 3 bottom numbers that we have are what we are looking for. So the 710, the 1340, and the 950 will then roll through to the top line of my direct materials budget, because I now know how many units I actually need to produce in that period. Now, in this case, it looks like we were told that each unit will require 0.5 direct materials, right? I don't necessarily know what that is in this case, but that's fine, right? I'm told that I need 1/2 of whatever, right? And so that's what I'll go with. So 0.5 times 710 tells me in this case I need 355 pounds of materials, right? I don't know what that material is. That's all right. Whatever that material is, I need 355 pounds of it. Now, I will need to add my budgeted ending inventory, which in this case, we figure out is 50% of that next month's requirement. So 50% of next month's requirement of 670 is 335. That simply drops straight down, telling me that this month I will need a total of 690 pounds of direct materials. But I get to deduct my beginning inventory, which was 178, coming down to the fact that I need to purchase 512 pounds of this material in the month of October. I'll then multiply that by my material price per pound of $20, and 512 times 20 is 10,240. Now, we can follow this through the same way for the next month, and what we will notice then is that whatever I had in my budgeted ending inventory for the month of October rolls through as my beginning inventory in the month of November, just as we saw earlier. Now, once again, anytime I am doing this, I think the best way for you to start is to go ahead and figure out this top section for each month. If you go ahead and do this, then you will have the information available that you need to do the rest of this. So I would always probably go ahead, calculate out these first 3 lines for each one of my months. Then you'll have available this number right here that you need to get this number, and you'll have this 475 available that you need to get that 237. And it just makes the question roll through a lot easier. Very good. Now, for my next question, or for my next budget, we will look at the direct labor budget. So we just looked at direct materials. Now we're going to look at direct labor. Now, the good news is direct labor is much easier to work with in terms of budgeting than direct materials, and it comes back to that fundamental difference in the two. I can store materials. I can't store labor, right? I can't pull 40 hours of direct labor off a shelf. It doesn't work like that. So this direct labor gets used in the period, so there's no beginning and ending direct labor, so we get to just come straight down. In this case, we see that I have 710 units that are needing to be produced, once again, from that production budget, times the 1/4 hour per unit is 177.5 hours of direct labor that are needed. At this point, all that is left to do is to multiply that by my direct labor rate per hour, in this case, $12, and that will give me the total cost of direct labor here, $2,130 for the month of October. I'll then repeat this same procedure for the months November and December. But this is the way that our direct labor budget will actually be prepared. So very good. Now, moving into my next budget, we now need to budget for factory overhead. Now, in this case, we will see that our factory overhead budget will show the budgeted costs for factory overhead, of course, needed to complete the estimated production. So we will be needing to factor in my number of units once again from that production budget, which is why I had to do my production budget first. So we'll come in and we will recognize that overhead has, once again, two components. We have variable overhead and we have fixed overhead. So we've seen these two pieces earlier in the semester, back whenever we were looking at the difference in how absorption and variable costing worked. We started really delving into this idea of fixed and variable overhead components. Well, here we're seeing it pop up again, just in a different light. So in this case, we will need to figure out the total overhead needed for each month. And the way that we will do that is by taking my number of units that have to be produced from my production budget for each month times whatever my variable factory overhead rate is per unit. And that will give me the variable overhead component for each month. At this next point, we will then need to add in my budgeted fixed overhead, and then that will come down and give me my total budgeted overhead for the month. Of course, we can then add all of that up and get my total budgeted overhead for the quarter. So very good. Now, at this point, we are able to calculate my product cost per unit. And the way that we can do this is by using the three manufacturing budgets that we just calculated: direct materials, direct labor, and overhead. So just as we've seen all semester, those are my three components of product cost, or unit cost, or inventoriable cost, whatever we want to call it. But that is what we are looking for. So we'll notice that in each case, I will go back to my direct materials budget, and I will see that I needed 1/2 pound of direct materials per unit, and I was paying $20 per pound. That is $10. For direct labor, I was paying $12 per hour. I needed 15 minutes of direct labor, or 1/4 hour per unit. That is $3. We see that my variable overhead was $2.50 coming through there. And of course, my fixed overhead was the $4,500 divided by the 3,000 units of expected production each quarter for $1.50, giving me total product cost per unit of $17. Now, once again, in this case, we are assuming that we will actually produce the same 3,000 units of product each quarter. If that was changing, then we would have to change that in our product cost calculation for each quarter. Now, at this point, we are now able to actually calculate my cost of goods sold budget. And the way that we're going to do this is by taking my budgeted sales in units times my product cost per unit. So you can see how this is all stacking down the list as we go. So we started out originally with that sales budget. Once we prepared that sales budget, we then came in and prepared the production budget. So we knew how many units needed to be produced in each month. Then we came down, prepared direct materials, labor, and overhead budgets. And now we are looking at preparing my cost of goods sold budget. Now, for this, of course, we come down and we see that we're using that $17 product cost we got a minute ago times however many sales we are expecting in each month or in that period as the whole. Now, my next budget is my selling expense budget. The sales expense budget is an estimate of the types and amounts of selling expenses expected during the budgeted period. In this case, the company pays sales commissions equal to 10% of total sales, but also pays a monthly salary of $2,000 to the sales manager. So in this case, we're going to reach all the way back to that very first budget that we saw, my sales budget. We'll pull in my budgeted sales numbers from there. That will give me the amount of my commission that is being paid. That is the variable component. The fixed component, of course, is that sales salary for the manager of $2,000 each month. At that point, we come down and we see that for the month of October, I expect selling expenses of $8,000, for November $6,800, and for December $10,400, giving me a total for this quarter of $25,200. Now, my next budget is my general and admin expense budget, and this plans the predicted operating expenses that are not included in the selling expense or manufacturing budgets. So in this case, Toronto Sticks Company has general and admin salaries of $54,000 a year or $4,500 per month. So in this case, that budget is pretty easy. We just take the 54 over 12 and we write down the 4,500 for each month. Now, my next budget is my capital expenditures budget. And my capital expenditures budget is just going to show the dollar amounts that are estimated to be spent to purchase additional plant assets, or this could show the amounts received from the sale of existing plant assets. Now, in this case, they do not anticipate disposal of any plant assets through December 19, but management is planning to acquire additional equipment for $25,000 cash in December 19. Now, since this is the only actual expenditure of this type, they're not going to show you this. But if you want to imagine what this would look like, it would basically look the same as my general and admin budget. The only difference is that we would put planned capital expenditures or something on that left-hand line where it says administrative salaries. We would see 0 for the month of October, 0 for the month of November, and of course that $25,000 in the month of December. Now, we're going to pull a lot of these things together, and we're going to now get ready to prepare my cash budget, which will show my expected inflows and outflows of cash during the period. Now, to some extent, this might be my most important one, right? In some ways, the sales is because it kicks off everything, right? If you get that sales budget wrong, it's going to flow down and mess up everything. But at the end of the day, my business can't run if I don't have cash to pay my employees, if I don't have cash to repay my interest. So the cash budget is an incredibly important budget because if we get it wrong, it can really put us in a bind. We've got to be very careful when we prepare this one. It's quite involved. So we'll start with my beginning cash balance and add in any budgeted cash receipts that we might expect. We'll then take out any budgeted cash payments. This will give me what is called my preliminary cash balance. At this point, we have to ask ourselves a question. Do I have enough cash? If I do, then I might use some extra to actually repay the principal on loans, to buy additional investments or securities. But if I don't have enough cash, at that point, I may need to increase my short-term loan borrowing to bring my cash balance up to the requisite amount. Now, that is my general formula. So let's start to see how this gets involved. So the very first thing that we need to look at is my sales. So we could have all of my sales occur in cash, but odds are they won't. So in this case, we see that about half, right, slightly less, 40% of our sales actually occur in cash. So when the sale is made, the cash is collected immediately. But the remaining 60% are credit sales that are collected in full in the month following the sale. So this is nice because it means that I get 40%. So let's say I had $100,000 in sales in the month of October. I would get $40,000 in cash in October, but I would get that remaining 60 in November. Now, in truth, we could see this actually straddle more than 2 months and see that 35% of credit sales are collected in the month following the sale, 15% are collected 2 months later, and 10% are collected 3 months later. And we could get this really deep layering that we would have to deal with. In this case, it only is dealing with these 2 months. So let's see how this works. Once again, reaching all the way back to that sales budget, we see that my 42, my 60, and my 48 are those budgeted sales amounts. And what we then see, the 42, of course, being from September, but we need that information now because some of those sales were in cash, but some of them were on credit. So what we will see now is that this 25,200 was actually the 60% of the 42 in September, meaning it will not be collected until October. But in the month of October, I made 60,000 in sales. Well, 60% of that, 36,000, was actually made on credit. So that 36,000 will run through and actually get collected in November, meaning that only the 60 minus the 36, or this 24,000, will be collected now in the month of October. So what I've collected in October is 40% of October sales plus 60% of September sales. And so we start to get this nice layering coming through. Now, for my next piece of my cash budget, what we want to look at then is those payments for materials. So managers will typically use the beginning balance sheet and the direct materials budget that we saw earlier to help us prepare a schedule for cash payments. Now, in this case, they tell me TSC's purchases of materials are entirely on account, and notice that full payment is made the month following the purchase. So this is a pretty easy policy for us to deal with, but we could, of course, see something similar to what we saw with the cash receipts, where we pay for 30% up front and 70% in the month following the sale, or a multi-layered period payment that we saw just a moment ago in the example that we talked through. So this can certainly become more than what we're about to see as well pretty easily. And the only thing that would have to change is that would say For example, we pay half the month of the purchase and the remaining half the month after, whatever the case would be. So let's see how this might work. Well, in this case, going back to that direct materials budget, we saw that we needed $10,240 in purchases for the month of October, $11,450 for the month of November, and $9,700 for the month of December. Well, in this case, what we will see is that my accounts payable balance at the end of September was actually $7,060. And so that will be coming out in this month as that full payment gets made for my September purchases. Now, my $10,240 in October, of course, will not get paid until November, and the same thing is true for my $11,450 in November, not getting paid until December. So the question then is, well, when will this $9,700 be paid? It will, of course, be paid in January in that next period. So very good. Now, at this point, we can look at starting to bring this together to actually prepare my cash budget. So just as a reminder, that general formula that we saw, the first piece of it was beginning cash balance plus receipts minus payments, and that gives me that preliminary cash balance. That is where we then split out and we ask the question, do I have enough cash or do I not have enough cash? If I have enough cash, then I can actually go ahead and start investing in other items, start buying additional trading securities, for example, or I can start paying down the principal balance of additional loans. If I don't have enough cash on hand, then I will need to actually increase short-term borrowing. So in this case, they tell me that as of September 30th, my cash balance was $20,000, and we plan to pay a cash dividend of $3,000 in the month of November. So the question then is, well, what is that $20,000 when I get to October? Well, that will be that beginning cash balance. Whatever I ended September with will be what I begin the month of October with. So in this case, let's see the information that we are given. So they tell me that we have income tax payable of $20,000 from the beginning balance. They plan to purchase that $25,000 of equipment in the month of December, and they have an arrangement with the bank for loans at the end of each month to enable a minimum cash balance of $20,000. Notice that they will pay interest each month equal to 1% of the prior month's ending loan balance. They will then repay loans when the ending cash balance exceeds $22,000. They currently owe $10,000 on this loan arrangement at the end of September, which of course means that will be their beginning balance in October. They have a 40% income tax rate, and they will pay taxes for the current quarter in the next year. So this is what my cash budget will look like. So we see then this $55,200, the $49,200, all these numbers, of course, coming from that cash receipts budget. Now, my beginning cash balance was the $20,000 that we saw before, and they had the $49,200 in cash expected, giving us that total of $69,200 in cash available for the month of October. So the next section we need to look at then is my cash payments. So now we need to take out all those cash payments that were expected. So we saw that we had to pay cash for direct materials, labor, variable overhead. We then saw that we were paying cash for my sales commissions, for my sales salaries, for those general and admin expenses, and of course, for that income tax. So that income tax is now being paid. You'll notice in the month of October that there were no dividends actually paid. So we don't have to deal with that at all. But what we will notice is that my ending balance at the end of September on that loan was $10,000. My policy says that I pay 1% of the outstanding balance on the previous month or on the beginning balance of this month. Well, since I owed $10,000 at the end of September, I owed $10,000 as of October the 1st, meaning that was my beginning loan balance that will be paying that 1% interest on. So 1% of $10,000 is $100. That will now be having to come out. And so now we will be seeing that this will actually come down. Let me get through all of this so we can hopefully get a clean view of this, and then we can just talk about the remaining items. Okay, so this is about as clean as we can get it, it looks like. So in this case, what we are going to see then is that whenever I come down with my $69,200, I back out all of these expenses that we've talked about, all of these cash payments that we've looked at. This will give me my total cash payments of $43,565, allowing me to calculate my preliminary cash balance of $25,635. At this point, we asked the question, what is my minimum cash balance I have to have? And they told me my minimum cash balance was $20,000. So I've got extra. We look at my policy. My policy tells me any extra I use to pay down additional loans. Well, I had a balance of $10,000. So I'm paying off this $56.35, leaving me with that $20,000 ending cash balance and reducing my loan balance to $43.65. At this point, we repeat the process. My ending cash balance, so let's just start here. My ending cash balance was $20,000. That will now become my beginning cash balance in the month of November. We'll add in my $55,000 in budgeted cash receipts, coming down to give me total cash available here of $75,000. We'll then subtract all of these items, which are my estimated cash payments, coming down to give me a total here of $31,954. At that point, this will leave me with a preliminary cash balance of $43,246. And you say, well, that's great. I have to have 20. I'll take $23,246 and pay off a loan and leave me with $20,000. But you have to be careful. We do not owe $20,000 on that loan anymore. We only owed $43.65. So I can now take this $43.65 to pay off the loan, giving me an ending balance here of $38,881. Now that $38,881 in truth is far too high. We only have to have 20. What I would like to see in practice is this $38,881 be split out where $20,000 would actually remain in cash and the other $18,000 would be used to buy something like short-term securities to actually get that money earning something for me. My cash just sitting in the bank really isn't doing much for me, so I wouldn't want this balance this high. But in this case, we don't have a policy telling us anything to do after we've paid off those loans, so we'll just leave this. At this point now, that $38,881 will then become my beginning balance in December, and we will, of course, repeat the entire process. Now, one thing I want to point out, though, is this $44 right here. This was calculated by taking my $43.65 times that 1%, because at the end of October, I owed $43.65. 1% of that outstanding balance is paid each month in interest. So $43.65 times 1% is $43.65. To make the math easier and cleaner, we just round that up to $45 or $44 in this case, and that is where this 44 came from. So very good. Now, we'll go ahead and clear out all of this, and we'll go ahead and move on to our next piece. So here at the end of the chapter, we're going to look at preparing budgeted financial statements. So of course, we have the same financial statements that we've always had. So we will see after I've run that cash budget, I am now ready to prepare my budgeted income statement. So my budgeted income statement is going to be the managerial accounting report showing our predicted amounts for sales and expenses. So in this case, we found my sales previously in that sales budget. So there's the 192, my cost of goods sold, of course, coming from that cost of goods sold budget, 54,400, giving me gross profit, 137,600. Now, my operating expenses, of course, we note that we calculated all of these numbers in those various budgets that we've seen before. So this is all coming through to a total here of $38,844. This will now allow me to calculate my income before taxes by taking my, let me get the box real quick, by taking my gross profit of $137,600 minus my total expenses here of $38,844. Giving me income before taxes of $98,756. They told me prior to this, we had a 40% income tax rate. So that is $39,502, giving me net income in the end of $59,254. So this is all taken from the previous component budgets that we dealt with up until now. And of course, the predicted income tax expense. They told me in that cash budget that my income tax rate was 40%. So we're able to see where that is all coming from. Now, once I've done my budgeted income statement, we can move into my budgeted balance sheet. In this case, we will see that my budgeted cash at the end of the period was $44,706. Coming through all of my various component budgets, we can find what all of these different items were expected to be, and we will come down. And the key thing here, of course, is that with any balance sheet, I will want to be able to check to make sure that my total assets actually do tie out to my total liabilities and equity. Now, if you want to actually roll through and see where all of these numbers come from, they provide a detailed description down here in the notes section. So if you want to go ahead and pause the video and look through that and try to trace that all through, that is fine. For the sake of brevity in this video that's already getting fairly long, I'm going to skip over it. But if you want to work through that, it's certainly not going to hurt you. Now, moving in to the next area, we can look at doing this for service companies. But the idea with service companies is they don't have production. So their budgeting is much, much simpler because they don't have those direct materials. They don't have all of those various components that we might see with a manufacturing company. So as long as you are broadly aware of the different types of budgets that are required for each. So for example, maybe look at this slide and look at the slide very similar to this from early in this chapter, early in this PowerPoint, where we first looked at all of those scattered out budgets for both companies, then I think you'll be well enough prepared for this section of the test. Now, the next area and the last area that we're going to talk about is what is called activity-based budgeting, which is when we base our budgeting on activities instead of the traditional items such as salaries, supplies, depreciation, utilities, et cetera, et cetera. So with a traditional budget, we will see something like what we have over here to the left, right? All those items that we are used to seeing. If I'm looking at activity-based budgeting, though, I'm looking at what is actually the purpose of the item. So instead of saying salaries, I want to know, for example, how much am I paying for auditing? How much am I paying for tax reporting, for financial reporting, for cost accounting, right? And I can then come out to a total. It's just a different way to do this. It certainly has its advantages and its own disadvantages, but just be aware, you can deal with the traditional budget or you can use what is called the activity-based budget. Very good. And with that, we have reached the end of our discussion here on chapter 20, because the rest of this actually deals with the appendix, and I'm not going to require you to spend a great deal of time here. If I need you to understand anything covered in the appendix, we'll deal with that in class. And so certainly be willing to do that. Now, if you're taking the class online, you may want to go ahead and read through Appendix A, as you could end up with, say, a multiple choice question on it. But it's certainly not going to be a large percentage of the test. So I would certainly spend very little time in Appendix A. You may read through it, just take a few minutes and at least familiarize yourself with the concepts. Certainly, if you're an accounting major, I always recommend that you read all of the appendices so you don't have any holes going forward. But if you have any questions, always feel free to reach out to me. I'm always happy to meet with you to help you get caught up. Once again, I hope you're enjoying the class, and we'll see you next time. Thank you.